Today's webinar is obviously presented by myself, and it's how to invest passively in multifamily real estate. I know there's quite a few people who have reached out to me individually via social media wanting to learn more. So I'm here really to serve you all in the best interest of, participating in real estate syndications. Oops, there we go. About myself. So for those of you who don't know me or perhaps need a refresher, my name is Chelsea Garber. I'm a full-time multifamily real estate investor, and I'm also the founder of Ascend Equity. I'm additionally the CEO of ROI by Design, which is a multifamily design firm focused on repositioning C and B class investment properties. I have an extensive knowledge in construction, design, and project management. I embarked on my real estate journey in 2019, burnt out and incredibly unfulfilled from a grueling career and life in New York City, where I owned a residential and commercial design firm. And I worked with some of the most successful and wealthiest individuals and companies. When I achieved a multiple six-figure income, I thought this was absolutely the pinnacle of my success and money would solve my problems. I quickly learned that was not going to be the answer. I did not come from money, although I had a wonderful upbringing, loving parents, and just about everything I needed. As you can imagine, the story did not end there. I left New York City in the rat race, drained emotionally and physically after a decade of living and working. Although this chapter of my life, which was mostly my 20s, molded me into who I am today, it was certainly filled with extreme highs and lows. The statement does remain true. If you can make it there, meaning New York City, you can make it anywhere, or so my father told me. I took the leap of faith because fortune favors the bold and moved out west, knowing just about no one or anything. At this pivotal point in my both personal and professional life, it became clear that if I wanted true happiness, there was going to have to be another vehicle to get me there, and real estate investing was going to be the way. At that time, little did I know the journey would be so much less about myself and so much more about the people that have come along for the ride. So together we've created impact on the communities we own, and in turn have generated an enormous amount of wealth, creating the time and freedom to live the lives we've always dreamed of while continuing to serve others. I currently own 286 units amongst 4 communities, 3 of which are in Oklahoma and 1 is in Ohio. Valued at over $28 million. I'm extremely passionate about elevating not only the quality of life for my communities and residents, but for our investors as well, because after all, these are our 2 greatest assets. I currently live in Park City, Utah with my boyfriend, Matt, my dog, Drake, and horse, Jazzo. I love to travel, ski powder. I'm an avid equestrian, a proud New Yorker, and I love living what I've tagged a 5-star life. So a little bit about myself, obviously some fun pictures to accompany that. I'm just quickly going to kind of go through Ascend Equity. Ascend Equity is a privately held investment firm driven by integrity and unity. And my motto is that our people come first and are the core of our decision making. When our properties thrive and our tenants thrive, our pockets thrive. Although one would think this is a standard approach, I have seen it been overlooked time after time in the real estate syndication world. So at Ascend Equity, we operate a little bit differently. We do acquire, own, and operate large-scale multifamily properties ranging in size from 51 units to 131 units. We place a heavy emphasis on repositioning these communities through strategic design and remodeling. As you know, as I've mentioned earlier, I'm being the founder of a multifamily design firm and having nearly 2 decades of experience. I have seen this strategy become a money-making machine, and that's not only in my own investments, but for ROI by Design clients who are similarly also investors, owners, operators. So you might be wondering what has been the key to our success. And it's an aesthetic-driven approach driven by professionals who ensure our money is spent wisely and gets the absolute highest return on investment, known as ROI. It is my responsibility as an owner and operator to provide clean, safe, and affordable housing, but also a place residents love to call home. I strongly believe that when people feel good about their environment and they thrive at home, they often thrive in other areas of their lives. So in addition to putting our tenants first, we take a really hands-on collaborative approach to owning and managing. We work very closely with property managers and the on-site teams to ensure that not only our tenants are set up for success, but our on-site teams and partners as well. And this means frequent visit to the communities, spending quality time with our on-site managers, identifying pain points, and addressing them head on with resources that will ultimately break the cycle. In a short time, I've learned that when you are well invested in the overall success of your communities and the lives of the tenants, the property managers and partners and investors, it just ultimately becomes a win-win for everybody. Real estate investing isn't just about the money, it's about the time. And I believe that is the ultimate luxury, and probably why most of you are here today, to learn more about how you can enjoy some of the luxuries outside of your 9 to 5. So if you are here and you're dreaming of living the life you've always wanted to, investing passively in real estate syndication, I hands down strongly believe is the best vehicle to create wealth so you can live a life with no limits. Okay, enough about me and Ascend Equity. So the topics we'll cover today: why multifamily, what is a syndication, general partner versus a limited partner, the return on your investment, a couple of steps to evaluating a syndication offering, and different ways to invest. So first and foremost, why multifamily? We've all been seeing it. It's become such a popular thing in the last, I would say, 3 to 5 years, as syndications are becoming more and more available, and there's more owners and operators like myself. There's obviously tons of reasons why to invest in multifamily, also referring to apartment buildings, and these include reliable cash flow, easier to finance, quicker to expand your portfolio, better management options, passive income, great potential for appreciation, high demand, and it's really considered a quote unquote safer strategy for commercial real estate investors. So let's dive into this a little bit deeper. Demand. It is no news that there is an increase in demand regardless of the state of the economy. People need a roof over their heads. Home ownership has dropped to 1970s and 1980s levels in the US. As you know, baby boomers are losing interest in owning. Millennials have delayed or abandoned home buying plans. And Gen Z, now coming of age in the largest cohort to ever live, is entertaining the housing market with rentals first. Furthermore, there is a lack of affordable housing options throughout the country, and demand continues to increase. So the chart here is basically from Fannie Mae, one of the larger lenders, and as you can see, vacancy continues to go down, and demand and rental levels continue to increase. Number 2, low risk. So when you're purchasing a multifamily property, the debt accounts for about 60 to 80% of the capital stack in most real estate syndications. And the investors contribute the remainder. Lenders typically favor multifamily rental income because it's from a diversified pool of tenants, which makes it a lower risk proposition. A multifamily property qualifies for lending based upon its finances, so based upon the income, the business plan, whereas in a single family investment, your really best comp is your neighbor. It doesn't matter if your house has all of the bells and whistles. At the end of the day, is based on comps, whereas in multifamily, it's strictly based upon the income of the property, and what it generates is what the property is worth. So lenders typically would consider this a lower risk opportunity. One statistic I do want to share is that when the housing bubble popped in 2008, the delinquency rates on Freddie Mac single family loans soared, hitting 4% in 2010. The delinquency on multifamily loans peaked at 0.4%. So I will never say anything is recession proof, but the facts are in the numbers that there is recession resilient is probably the better term. As we've stated before, regardless of the economy, people need a place to live. Thirdly, why multifamily? Cash flow and appreciation. The property creates monthly cash flow that you can rely on from the rental payments. So after you've paid the debt and the expenses, you have your income, which is generated by rent and other income. And if one unit becomes vacant, you can still count on the cash flow from other tenants. So if we have a 51 unit property and we have a couple vacancies, we're not losing sleep over it because we know that they're going to be soon occupied, and additionally adding cash. And either way, it's not going to make or break our bottom line. When it comes to appreciation, a lot of these opportunities we're both organic and we're forcing appreciation, meaning we're making upgrades such as adding security, laundry rooms, communal living spaces. And this all really positively impacts the tenant base. And in turn, you get higher rents. Additionally, you can do exterior renovations. So not only is it functional, but it's all aesthetically pleasing. So all of this adds to the appreciation. And of course, you have to maintain your property to a high standard and secure strong cash flow for both, cash flow and appreciation to take into account one of the many reasons why multifamily. Number 4, and probably one of my favorites, especially right now, is a hedge against inflation. So most apartment leases are for 1 year, which means rental changes can happen frequently, and you have the ability to adjust rental rates to match the market, given the tremendous inflation resistance. So, and along with that, you lock in low long-term fixed debt. And last but not least is the tax benefits. So one of the biggest benefits investing in real estate are the tax advantages. So when you invest in a real estate syndication, you're essentially purchasing shares of an LLC that owns the asset. And this structure allows you to take advantage of what are known as pass-through taxation and the depreciation deduction. So kind of the long and short of it is that a property over a 27.5-year period depreciates, and we do a cost segregation with a bonus accelerated depreciation. So we take all of that appreciation up into 5 years, with most of it being in year 1. So in turn, you get these pass-through, basically passive losses that you can is taxed at an individual level. And this allows you to have tax deductions each year. So you will receive a K-1 showing your income and losses for a syndication. And in many cases, like I mentioned, due to the cost segregation and accelerated depreciation, the paper loss can be quite substantial, particularly in that first year. Okay, what exactly is a multifamily syndication? I know the word syndication is a bit foreign to some and then not to others, so I'll kind of go through it quickly here. Basically, it's referred to a real estate investment syndicate is a type of investment that involves bringing a group of people together. It could be anywhere from 2 to 10 plus people. However, sometimes maybe in a fund or crowdfunding or sourcing, it could be 50 or more people. And essentially, we pool our money together and purchase a property. And a real estate syndication is an absolutely incredible way to get involved in real estate without having to do it alone. So rather than investing in a single family rental property on your own, you get to pool your money together with other investors and invest in these larger assets, like an apartment building, together. The property is then, of course, owned and managed by the general partners, which I'll get into next, and the limited partners, which are the passive investors, share the profits and the losses that are generated. When you invest passively through a commercial real estate syndication, you don't have to deal with the burden of tenants and toilets. And I can tell you all that you deal with them, and sometimes it's not fun, regardless if you have a property manager. Some other positives of investing in a syndication is that you get to tap into real estate markets and opportunities that would otherwise be unavailable and or unaffordable to you as an individual investor. So most individuals do not have the capital to purchase a large commercial property outright, but when you invest through a limited partnership, a syndication, you get involved with these types of deals at a fraction of the costs. Investors provide the capital needed to purchase and redevelop the property. It's all part of what's the down payment, the CapEx, the closing costs. And in exchange for your investment, you'll receive a percentage of ownership, essentially in the form of equity, because you're investing in an LLC as a member, so you get equity shares, and that entitles you to a portion of the income that's generated on a monthly basis, as well as at the end of the lifetime of the deal when it sells. So just a couple ins and outs of a syndication. Okay, a general partner versus a limited partner. This is a very common term. General partner, often referred to as the GP, or the limited partner, often referred to as the LP. In simplest forms, there are two parties involved in a syndication, and those are the general partners and the limited partners. I heard a really good analogy of how to put this is like, think of it as an airplane ride. The active investor is the pilot, the general partner, and the passive investors are the passengers. So everyone is on the plane, is going to the same place, but their levels of control and involvement are very different. So who are the general partners? Those are the pilots and the flight attendants, myself. We're the ones that are operating and managing the investment. And we're basically responsible for, there is a long list of duties, but to break it down, the sponsor and the GP identifies the property and does the full due diligence. We create the business plan, we secure the loan and the insurance policy, we raise capital, whether it's through friends, family, sphere of influence, institutional equity. We purchase the property. And then really most importantly, we implement the business plan, and which is typically involves renovations and improvements. We manage the property manager who manages the tenants. We do tax reporting, we manage the finances, we decide when to refinance or sell, and we're also in charge of distributing any profits. So really, your GP is the captain of this ship, and that will be the ultimate success of the opportunity. So that leaves the limited partners. The limited partner is the passenger on the plane. Your job is to get on, to sit back and collect your money in the simplest forms. You have a couple of roles though, however. It is important that regardless, you do your due diligence before investing in a deal. You physically invest your capital. You review quarterly updates, which usually come in the form of newsletters. You will receive deposits via your bank account, and you will then get a K-1 at the end of the year, and it's your responsibility to provide that to your CPA. So the benefits, in my mind, of being a limited partner is beyond investing your capital. You're not expected to put any more time or effort into the investment. You are truly a passive investor. So if you're looking for something passive, this is as close as you can get to investing in real estate without having to do all of the heavy lifting. And just a couple of questions. Sometimes I have a lot of conversations with individuals and they're kind of questioning, well, do I want to be a passive investor? Do I want to be an active investor? And it really just depends ultimately what your goals are and how much time you have. So there's like kind of a handful of things I always like to say and ask yourself. First and foremost, do you want to deal with tenants, termites, and toilets? Do they excite you or do they terrify you? Because you are going to be dealing with them if you are on the active side. However, you might come over and say, this isn't for me, but if you don't want to touch any of that with a 10-foot pole, I completely understand. And you're probably better off with a back seat. One of the other second most important aspects of being active versus passive is the amount of time you have. So how much time do you really have to devote towards your investments? Actively managing these communities requires a substantial amount of time. It is a full-time job. And both during the initial acquisition, throughout the life cycle of the project, you are very much on board. With passive investing, of course, you do some upfront research, some vetting, and then you can really hopefully sit back. Then, of course, there's the level of involvement. As an active investor, we get to choose, the design and aesthetic. We work with our property managers, to address issues. We make decisions on renovations, et cetera. And as a passive investor, you are really putting your trust in the general partners to for the property to succeed. However, the profits, I will say, can be, incredibly lucrative on both sides of both the general partners and the limited partners. So you are sharing, your profits with other investors. It doesn't necessarily mean that your return on your investment will be lower than if you were, let's say, active. It just depends on the deal, the market, the loan, the business plan, et cetera, how much you've invested, of course. And then there is a ton of paperwork as an active real estate investor, both through the initial investment process, bookkeeping, reporting, legal. It is just, there is as much front end work as there is and back end work. And ultimately, real estate investing is a team sport. So as an active investor, you are putting together teams, whether it's other general partners, property managers, contractors, strategic vendors. There is a lot of organization that continues, and relationship development that continues throughout the life of the deal. So just a couple things to keep in mind. I will say that lastly, that regardless if you're active or passive, you can still create the same impact. And so if you want to have a broad impact, you can do so as a passive investor, because you're able to invest in more assets and bigger projects, and your money just ultimately goes further. Okay, return on investment. This is kind of the bread and butter here. At this point in the presentation, you might be thinking, this all sounds great, Chelsea, but how much can I actually make by investing in a real estate syndication? And you make money a couple of ways. The answer is definitely dependent on the deal. But what I can tell you is that when you invest in a syndication, you make a profit two different ways. One is from the ongoing cash flow, and the other is the profit from the sale of the property. And in this chart here, you'll see this is the split between the general partners and the limited partners. In a typical split, it's usually around 30% of the ownership is for the general partners and 70% as the limited partners. So the limited partners are the majority stakeholder. And of the, what we call the capital stack, you have the leverage, which would be the debt. So in this case, let's just assume, 75% leverage. The 25% equity is then the 70-30 split. And the equity, as I mentioned earlier, is the money that's going to be part of the down payment if we're planning to raise capital for any additional CapEx, closing costs, attorneys, et cetera, et cetera. A common syndication structure is a hold period of 3 to 5 years. I've seen deals that have been longer, 5 to 7, but I'd say generally 3 to 5 is sort of the time that it takes to, once you've acquired an asset, stabilize it, continue to generate more income and cash flow, and sell in year 3 to 5 is typically when it becomes most profitable. So back to how you get paid. So the ongoing cash flow is typically paid out on a quarterly basis throughout the life of the deal. And then from the profit, the sale is paid out upon the exit, which again could be 3 to 5 years' time. Just a quick example, if you were to invest $100,000 into a syndication with a projected return of, let's say, 8% cash on cash, that means the real estate investor, limited partner, yourself, would get 8% of your investment per year. So that would be $8,000 a year. And if you do $8,000 a year over the course of 5 years, it comes out to about $40,000 in return. And then there's the profit from the sale of the property in year 3 to 5. With a common equity multiple of around 2x is generally what you're seeking. That means you're projected to double your money during the 5-year hold time. So when you add up both the quarterly income and the profit from the sale, you've gotten your $100,000 investment back, the $40,000 in returns during those 5 years, plus another $60,000 in profits. And this, just in case anyone isn't aware, gets divvied up based upon how much you've invested. So you basically doubled your money in the 5 years. So when you look at it over the course of 5 years, you get an average annual return that, in this case, in this example, would be 20%. which would be doubling your money, 2x. That is the simplest way I can put it without going into any more details here. Next steps, you've done your due diligence, you're ready to dive in, maybe you're looking at new opportunities. How do you evaluate a syndication offering? There are a lot of different owners and operators out there and ongoing opportunities, and choosing the right one is important. You, of course, want to do your own due diligence on the offering. So you're going to, and that means not just on the offering itself, but also the partnership. You will typically see a deal summary. Then there's a webinar and other, external sources. And then, of course, the due diligence phase. The syndication deal summary, in short, is a document that outlines all of the key metrics of a real estate opportunity. Will include the property name, location, the purchase price, the expected returns, projected timeline, the sponsor, so like myself, our team experience. And as we saw in the slide before, you'll generally see what the returns are going to be broken down over the life of the deal. Next, there's generally an investor webinar, and that's a video presentation given by the sponsor team that goes really just into more detail about the deal. This is your chance to ask questions and get to know the sponsor team better. After reviewing the investment summary, watching the investment webinar, you should have a good idea whether this deal is a good fit for you. And then lastly, you would move on to your own due diligence. Due diligence is just the process of gathering information about the real estate property and the sponsor team, just so you make an informed decision about whether or not you want to invest. You would review items such as the property financials, what are the fees, who are the third-party managers, and do your own due diligence on the asset type, the location, the population. Are jobs trending there? Are people moving into the city? Are they leaving the city? Sort of all of the things. And if you choose to move forward, you then review and sign a PPM, which is a private placement memorandum. And if it's a 506C offering, meaning you would have to be accredited investor, you'll have to verify your accreditation status. And last but not least, you wire your funds in time for the closing. There are a couple of ways to invest. So you can invest with cash. You can invest through a business entity or a trust. And additionally, you can invest from a self-directed IRA or 401k. The quickest and easiest way to invest is solo with cash, meaning you enter the deal as an individual, no partners, with capital from either your checking, savings, or any other liquid assets. And you basically fill out all the documents and you simply wire your money into the deal. Secondly, you can invest through a business entity or a trust. So you can form an LLC that you own solely or partially. You don't need any employees in this LLC. It's just for the interest of investing. And you don't need a board of directors, which is required for a corporation, but establishing an LLC is often a common way to invest because it separates basically your personal assets from your business assets, giving your property to your LLC. And if it runs into financial or legal trouble, people can't seize your assets. However, I'm obviously not an attorney, but your LLC needs to be in good standing and compliance, and conducting business accordingly and not being used simply as a place to hold your assets. And of course, there's the other regular events that comes to owning LLC, which is filing tax returns. If you have members, you'd have meetings, etc. Another way to invest is, I would say, fairly common. Probably not the top way. I would say most people do through LLC or individual, as well as through an IRA, as also a trust. So there's two different types of trusts. I'm not going to go into those today, but there are benefits of going, whether it's an irrevocable trust or a revocable trust. But essentially, these are all questions that you want to have with your CPA ahead of time, just to understand what's best for your financial situation. And last but not least, something that I'm really excited about that I think a lot of people aren't quite aware of is that you can invest through a self-directed IRA or 401k. And this is just so awesome because I know so many people have money in their, it can't be a current 401k. It has to be from a prior job position, but it is possible to invest in an apartment syndication with your retirement funds. And really, once you get comfortable with the idea of using these funds this way, the procedure is very similar to other types of investments. The only difference is that the self-directed IRA accounts and the solo 401k are a little bit different just because how they're managed. But essentially what you do is a self-directed IRA typically has a custodian that acts on your behalf in terms of reviewing, signing documents, and funding the investment. Whereas a solo 401k is usually managed by yourself, the owner, and you can contribute to an investment that way. One important thing to note is that you should have your alternative retirement fund set up before you're even thinking about investing. The process of establishing these accounts can take upwards of 6 to 8 weeks, and a standard multifamily syndication fund usually closes in 60 to 90 days, sometimes even less. So it depends on whether you're using a 401k or an IRA to transfer into the custodian. So you'll first and foremost need to open an account with a custodian. It's very inexpensively, and there's just a yearly fee for basically to manage the account. I'd be happy to connect anybody here with a custodian that I work with, like and trust. And really, it's a process is fairly painless. Okay, let's connect. I'm gonna send out this presentation via email probably tomorrow to everybody. Obviously, I love to make myself available to everyone, share my stories, both the ups and downs of multifamily. I've always, prided myself on being transparent here. So please feel free to reach out to me directly after the presentation, and we can set up a call or a Zoom in the upcoming weeks. And additionally, have some information here for my multifamily design firm as well. We go sort of hand in hand. I'm going to stop here and open the floor for any questions that anybody might have. I know it was a lot of information in a rather short period of time. So feel free if anybody wants to drop something. Oh, let's see.
Hey, Chelsea, that was great. Thank you.
You're welcome. Hey, Alan, I didn't even see you. My screen was like off to the side.
I showed up late, but thank you. That was really, really well done. I don't have any questions. I just wanted to say thank you.
Oh, no, thank you for being here. I'm looking forward to connecting with you soon and see what kind of magic we can create together.
Okay, cool. Thank you. Bye.
Bye. Okay, from Benny, do you focus on any specific areas? Yes, so I am heavily invested in Oklahoma, largely. I currently own 3 communities there, and I do own 1 community in Columbus. Oklahoma and Columbus have similar metrics. They're slow and steady, wins the race environments and economies that are diverse economies. So, if one corporation goes out of business or another suffering, the whole local economy does not collapse. Also, through lots of market research, I started investing in those areas because they are significantly more recession resistant to some of the major cities, which, as you are probably sure very well aware, take major hits when there's an economic downturn. Whereas in these economies, they're just not as affected as greatly. And you get both appreciation and cash flow in these markets. And that's what we look for in order for these opportunities to work. I personally love Oklahoma, have an absolutely fantastic team there. Really, the success of multifamily comes down to not just the owner and the operator, but your property manager. And we have just a world-class property manager in Oklahoma. And I've dealt with some non-great property managers as well, and they will ultimately make or break your opportunities. So haven't ventured too far out because there's great, I have great relationships there with brokers and contractors and all of the key people that make these such a huge success. So that was a very long answer to your short question. From Heather, what's a standard amount you see people invest or recommend people investing? That's a good question. Typically in a syndication, the investment minimum is 50,000. There are, of course, times where we'll make exceptions. People generally, I would say, invest anywhere from $50,000 to $150,000 at a time. I've worked with institutional investors who have written $1.5 million checks, though, too. So the amount of legality and paperwork and onboarding can be extensive. So that's why we try to stay at the 50,000 or above. Brandon. Oh, you're welcome, Brandon. Yeah, Brandon is a seasoned investor, and he said sometimes the SD IRA gets overlooked. So if anyone's on the fence about getting into their first deal, this might be a good starting point. My wife and I both invest in our first deal through our SD IRAs. Oh my gosh, I love this so much because it is just something that not everybody knows about. And I believe that strongly, of course, that multifamily is an incredible asset. And if you can leverage retirement funds that are sitting in accounts making a couple points a year, why not? If there's legally, it's amazing. So yeah, good call. Thanks for being here, Brandon. I always appreciate your insight. It's good to connect and be on both sides of, I invest both actively and passively. So it's great to connect with people who are like guys like Brandon, who have done this so many different times and see different deals and different opportunities. And the more you start investing, the more you start to know exactly what you're looking for and what might be the red flags. But ultimately, you put a lot of trust into the owner and operator. And I would say the most important part of this is just communication. Like, how well are people communicating with you, not only on a quarterly basis when things are going well, but in the times when things don't go well, because you will hit speed bumps along the way, and a strong team will step in and make things right. And ultimately, that's okay. This is we've got to remember sometimes too, we're looking at a big picture here. 5 years is a long time. There's going to be some bumps in the roads. It's just how well can you get through them and come out the other side. So that's probably a good takeaway as well. Benny, will the equity multiplier eventually become more compressed as price go up? Yes. So what we're seeing right now is that with increased or rising interest rates, I think the Fed was doing another hike today, is that ultimately cash flow goes down. So when your debt becomes higher, you can only raise your rent so much, and your expenses also go higher with inflation. There is less money to shell out essentially on a quarterly basis, on a cash basis, and at the end of the return. However, when you look into an investment opportunity, you're underwriting a deal, in my opinion, how we do it, on the absolute most conservative way possible. I'd much rather under promise and over deliver. But in short, yes, prices, the returns we're seeing now and how we're underwriting deals and we're educating our investors is that I'd rather tell my investors you're going to see a little bit less in cash flow and maybe appreciation, but still know it's a really good deal and go in conservatively. So just keep that in mind. Also, what I'm seeing right now is I'm looking at a lot of deals. There's what 6 months ago people were fighting over opportunities has significantly changed. So the buying power is transferring from the seller to the buyer, and it's an adjustment period. So we're seeing that the prices are starting to come down. However, we haven't quite met in the middle, and that's because debt is continuing to rise. However, what I'm seeing more of that was not in any discussions 6 months or 18 months ago is, different options to buying, such as creative financing. So a lot of times sellers have a lot of equity in a deal and they want to sell and they want to get top dollar. Well, in order to do that, they have to be willing, or most are willing right now, to leave equity, basically to carry back a debt on a property at a much lower fixed rate than standard traditional debt would be right now, or what we would pay our investors. So that's having a lot of conversations with owners and sellers about that as well. So there's there's always deals to be had. I will absolutely say that. They're all hard to come by. You know, if there were great deals everywhere, everybody would be doing this, but we'll look at 20, 30 deals before we even maybe put in an offer. And it's an extensive underwriting process of doing your due diligence on the property. If I put out an offer, I'm going to stand by that offer, and I'm not going to look to retrade. So I, want to have the utmost respect and just respect in the industry, in the space. So you can tarnish your name really quick in this business. So yeah, good question on that. And that's again too why we lock in this long fixed debt. So people who maybe a year ago were doing bridge loans at 3%, but had no rate cap, and now their interest rate, their rate's at 7%, you're going to start seeing people going under because they simply can't pay their debt and their expenses, and definitely not their investors. So I think there's just going to be incredible buying opportunities here in the next 6 to 12 months as things start to correct. Multifamily is, we are lagging a bit behind because rents have continued to go up in just about all of the markets, mine included. And now we're kind of saying, okay, I see that we're at the top of our rental market. Inflation is a real thing. And if you're in affordable housing, there's only so much money somebody's making that they can pay for their living expenses and their rent and afford to survive. So it is a real factor out there. Any other questions, comments, thoughts? Like I said, you guys can all feel free. I'm going to drop my email in the chat. You can shoot me an email. I would love to connect. It's just always great to get to know everybody, learn more about what are your goals? What makes you happy? Like, I am living the life of my dream through real estate investing. I love to, like I said, I love to ski, horseback ride, all these fun things. And it's just about creating more time and flexibility and freedom around that. And most of the people who invest in our syndications are very successful professionals that they don't necessarily want to leave their job or, their company, but they want to create long-term legacy wealth, and you can build it rather quickly through real estate, and give you the opportunities to just go enjoy life and do the things that you like and not feel strapped for, the extra cash. So always excited and happy to talk about these opportunities and just, bump heads with people. So yeah, if anybody has any more questions, I'm happy to stay on. If not, I just, so appreciate everyone today for joining. I hope you learned something. I always get so much out of these, and I hope you did as well.
Thanks again. Have a good rest of the day.
Thanks. Bye,
All right.
Brandon.
Yes,
Bye,
see you
guys.
later.
Great, thanks,
Thank you,
Chelsea. This was
Chelsea.
great. Thanks.
You're so welcome. Thank you.